IVM.
BQ Big Decisions, the BloombergQuint podcast that helps you make the right financial choices. If you're a long-term investor in equity, there are a few guiding principles that can help you make the right choices. First, you know that you're unlikely to make the so-called multi-bagger returns overnight. Most advisors say it's best to buy equity and let it grow for at least 5 years. Second, don't try to time the market. It does more harm than good. Third, be aware of the inherent risks. While you could make returns that are far superior to other investments, you stand the risk of losing as much as you could potentially gain, if not more. And four, don't simply trust your gut. Be aware of what the company you're investing in does and where it stands among its peers. That's admittedly a long list of rules to follow. It's hard enough to do a day job without worrying about which company you're going to hitch your investment wagon to. That's why financial planners advise that you put your money in mutual funds. But there's a catch here too. When you choose a mutual fund scheme that's managed by a stock-picking expert, you're trusting his or her judgment about which group of stocks will outperform the rest. And choosing the right scheme from the hundreds available is possibly as challenging as picking the right stock from over 500. But there is another option. You could choose what is called the passive route to investing in equity mutual funds. Hello and thanks for tuning in. This is BQ Big Decisions and I'm Alex Matthew. You're listening to BloombergQuint. Joining me on this active versus passive mutual fund debate is Aashish Sommaiyaa, the Managing Director and Chief Executive Officer at Motial Oswal Asset Management, and Pratik Oswal, the Head of Passive Funds at Motilal Oswal. Thanks, gentlemen, for joining me.
Thanks for having us.
Thanks, Alex.
All right, so let's get to the crux of this conversation. And I think, Aashish, you'll want to weigh in on this. Would it be fair to say that despite the changes in the definitions of mutual fund schemes that have been spoken about very widely, that essentially made the objectives of these schemes clearer, it's really hard to choose the right actively managed fund, right?
Yeah, I mean, because conventional wisdom or the usual practice is to select funds based on their past track records and stuff. And in my experience, past track record is good enough for someone to kind of get into your consideration set. But you're not concerned with their past performance, really. What you're concerned with is the sustenance or the future extrapolation of that performance. Yeah. So I don't think, I think that no amount of standardization can eliminate this fact that, you are ultimately tasked with identifying a future winner. Mm-hmm. And is there a perfect science to it? Not sure.
And that boils down to the manager of the fund and really studying what his strategy or her strategy is and whether it fits into your overall strategy. So you essentially have to understand some element of it. You can't go into it blind.
Yeah, I mean, there are 2 or 3 things to this. One, clearly, like you mentioned, a particular fund manager, his track record, his ability to outperform, etc. Plus also the fact, that despite the best intentions and the best credentials, the fact is that market landscapes change and winners rotate. There is enough data and evidence which shows that, if you picked consistently the number 1 ranked fund in the past 3 years and you put money in there and then you held it for the next 3 years, there is practically zero correlation between the winner of the last 3 years and the winner in the next 3 years. So winners rotate, and despite best intentions of fund managers, their credibility, their track record, the fact is that markets rotate, and in certain circumstances, a certain bunch of stocks is in favor, and then things happen, and then another bunch of stocks comes in favor. And if you really think that you will get a fund manager who will always be at the frontier of the next cycle of growth, then I think that's a hard task.
Absolutely. And that's where passive funds come in. The reason why we're speaking about it is it's the so-called easier choice to make. Why are we saying this, Pratik? And just for the benefit of the listeners who are tuning in, who don't really know what passive funds are all about, what are they?
Thanks, Alex. So basically, passive funds are... So there's 2 sorts of investing in India when it comes to mutual funds. One is a type of investing called active investing, where you're basically giving certain fees to a fund manager who then uses those fees to sort of figure out which stocks to buy and sell, and then that's basically an active mutual fund. And the second type of investing is called passive investing, where basically you're just giving your money, and that money is going into a portfolio that just replicates an external benchmark or an index. An example of that index is, say, a Sensex or a Nifty.
Okay.
That's the most common ones, but there are actually multiple indexes out there. There's a mid-cap index, there's a small-cap index, there's a multi-cap index. So the idea behind passive investing is to actually, be able to replicate or have the same returns of the index. So today, if you're invested in, say, a Nifty 50 index or a Nifty 50 index fund or an ETF, then if the index goes up by 10%, then the fund will also go up by 10%.
Okay, and that's broadly, and just to make the point here, we have had one conversation on index funds and what they are. We haven't gone into the details of what is the difference between index funds and ETFs, but broadly, if we're talking about an index fund, it's basically, if we're talking about the Nifty 50, it's investing into the 50 stocks based on their market capitalization, right?
Absolutely.
The weightage.
Absolutely. Yes,
so Reliance
absolutely.
Industries, being the largest market cap company, will have the biggest weightage, and therefore most of the money, if you put 100 rupees, the weightage of Reliance Industries would be the amount that you buy in Reliance Industries, right?
Absolutely, yeah, absolutely. So basically, yeah. So the way the index works is that the index is actually a very self-adapting sort of an index. So what normally happens is the big companies end up getting a lot more money coming in, and the small companies get less. So because of this mechanism, if you think about it, say 15 years ago, the index was heavy on infrastructure, heavy on industrials, whereas today the index is heavy on, say, financial services. So what happens is, because of this mechanism, the index is great because, today, at least I would say 60 to 70% of the stocks haven't gone back to their highs in 2007, but the index has gone up 2.5 times.
Okay.
So this self-adapting nature is it's what ensures that you always have the best quality stocks in your portfolio if you invest in index.
Very quickly, I want to understand, is the basic difference between ETF and index fund the fact that one, you need, obviously there are multiple, but the primary thing in terms of buying it is that you need to have a demat account for one and you don't have to have one for the other?
Yeah, so at Motial Oswal, we've actually been in the passive investing space for almost a decade now. And we actually launched our business with ETFs. So ETFs are exchange-traded funds.
Yes.
So they're basically passive funds, but are listed on the exchange. So you can buy an ETF in the morning and sell it in the afternoon.
Okay.
And this obviously is fairly, I would say, a lot more popular in the West, say in the US and Europe, because I think they've had 20, 30 years of more time to develop these products. Whereas in India, today, if you think about it, the ETF is actually a very hard instrument to buy and sell because there's not as much of liquidity in the exchange. So, and the reason to that is because there's so many parties involved when you're buying an ETF. So a typical investor, especially an HNI or retail investor, he has to go through a market maker, an exchange, a broker. In addition to that, he has to have a demat account. He can't do an SIP. So I think those are some of the reasons to why I think ETFs are not the most customer friendly. So we think index funds are a lot easier for the investor.
As of now. I want to talk about this in a little more detail, but before I do, I think I want to drive the conversation slightly down a different path. Aashish, we've been speaking primarily about active funds for quite a few years now. We haven't spoken as much, admittedly, about passive funds. And that really isn't the case, like Pratik just mentioned, in the United States. In fact, I was just reading that in September, the total assets under index funds and ETFs in the US went beyond or crossed the amount of assets that are managed by actively managed funds. And so it's a very large chunk of the pie over there. It's not as much here. Why do you think that is?
No, I think one of the things which Pratik already mentioned is still early days, because if you see in India, the mutual fund industry and more specifically equity mutual funds, I think it's taken off only in the last few years, maybe less than a decade. Private sector mutual funds in India are about 2 decades, and I think the equity cult is barely a decade or so. So I think that is one very big reason. The second reason is that in India, in the past, it has been that way, and there is a belief that markets are not as efficient and as institutionalized as they have been in the Western world. So there are probably certain inefficiencies in the market which makes people believe that portfolio managers can pick up certain stocks ahead of the curve and they can outperform. And past data does show that there have been very many managers who have consistently done better than the index. So the key point is that I will entrust money to a manager if I think he's going to do better than the average for me, and the average is the index. So if I think that I can find someone who can do better than average for me, I would entrust money to him even if I have to pay a fee. But then over a period of time, if I realize that all of this is not resulting in extra performance, then why should I pay an extra fee? And so then I satisfy myself with the average, which is the index. The second thing is that, I think as more and more people come in, so apart from outperformance and underperformance, I think as more and more people come in, they will realize that there is a value to simplicity.
Yes.
Because when we opened this discussion, you mentioned about how hard it is to make decisions and to choose portfolio managers.
Yes.
So outperformance is one, and second, I think, is simplicity. So my sense is we'll get there.
Okay.
I don't know how much time we take to become like the US. Maybe take a longer time, but I think we are getting started now.
You mentioned a few of the qualities, shall we say, of passive funds that probably in some situations make them better than active. But I would hazard a guess and say that more and more people talk about passive funds after there has been just a bit of a bull run. Because you will look at your portfolio and you will look at the index and you will say, okay, my portfolio is beating the index by, say, 2 percentage points, but my expense ratio is 2 percentage points. So really, what am I gaining? Especially in a situation where an index fund, the expense ratio is anywhere between 7 basis points and 30. So is that a major factor, you would think?
Yeah, I think in India, if you're alluding to, a bull run, I think in India, the discussion has become a bit more active last year. The active-passive discussion has become more active in the last year. The reason being that, as is widely discussed, the market rally has been pretty narrow.
Yes.
And a lot of portfolio managers, I have not seen that in 2019, but 2018 specifically, a lot of portfolio managers kind of struggled to keep pace with the index. And I think that that's where the discussion started. My personal opinion is that the discussion shouldn't start and end only when there is that kind of phenomenon. I think it should be a consistent, continuous, ongoing discussion because irrespective of outperformance or underperformance, the fact still remains that simplicity is something which people want and people should look for. Why complicate things when you can have simpler solutions? And investing is one place where I don't think there is any harm if you satisfy yourself with the average. Right through our childhood, we are told that we should try to be number one in the class and stuff. But in investing, by and large, it is seen that if you are at or around average, you'll do a good job.
Is there data to suggest, Pratik, that you would be better placed, especially if you were talking about the long term, and you're talking about 5 years hence? That's what the point that I made earlier, and that's in fact what most of the experts point to with regard to allocation of funds, that choosing passive, especially if you have a particular goal that you're working towards, is a better idea than choosing active?
I think for me, so I'll give an example. So when I was managing money for wealthy people in the US, and these are people who are, they have wealth of over $25 million plus.
Yes.
So there you've had passive funds for was 45, 50 years.
Yeah.
So, and if passive won or if active won, they would have had 100% of their portfolio in passive or 100% in active. But the reality is that almost all of them have a mix of two.
Yes.
So I think what I've learned in my experience is that I think passive is a great core portfolio. So if someone is looking to say invest for say 5 to 10 years plus, then I think it makes sense to have a lot of passive in your portfolio because there's a lot of risk when it comes to having fund managers for that long.
Sure.
And I think the core portfolio which shouldn't be touched ideally should be in passive.
Now, Aashish, you wanted to... Sorry, I'll just come back to you on that one. But Aashish, you want to make a point?
Yeah, I just want to... what Pratik said, your question and then what he said set me thinking. I meet a lot of retail customers. And I think what is one thing when you mentioned about planning for the future and the goals and active and passive, at least one thing is clear, that beating the benchmark is not a financial goal.
Yes, no, clearly not.
Yeah,
clearly
because
not.
a lot of people think that if I'm investing, I should beat the benchmark.
Yes.
Well, the holy grail of investing is to reach your milestones or your goals. A lot of people can reach their goals by generating just 8% or 9% or 10%.
Absolutely.
Right.
You were talking about why, you in fact alluding to managing funds abroad.
Yes.
And you were saying that it's a good idea to have the core of your portfolio as passive because you're cutting out that volatility that you could potentially see in active. Are there any other reasons you would say?
Yeah, so just simple goal planning, So I think so there's two main points. One is that, each of the funds, the passive funds, have a track record of 20 years plus.
Okay.
So when you're planning a goal for, say, 5 to 10 years, you have a lot more dependability on getting to that goal. When you have that longer track record, the risk is actually consistent. So the risk in a passive fund today versus 10 years ago is exactly the same.
Yeah.
So you can expect the same amount of volatility in your portfolio.
Okay.
And second, there's no underperformance.
Okay.
So I think if you combine all of three, then goal planning becomes relatively less difficult, especially when you're doing, say, 5-year plus sort of goals. And the second point is that, I think the low-cost nature of these funds itself. So I think what most people don't realize is that, I think most people have been able to do really well over really long time periods because they managed to keep costs low. And those things add up, not maybe the next 2 or 3 years, but if you're investing for, say, 10 or 15 or 20 years, those things add up.
And specifically, I think this is another common practice for a lot of retail investors. They tend to buy a large number of mutual funds, equity mutual funds that are actively managed. And that cost really builds up over a period of time. Rather than buying, say, 8 across a platform, across a mutual fund category equity funds, wouldn't it be better to choose just one large ETF or one large index fund?
Yeah, I think that, you're right, because what I've seen is that even when people have identified a fund or a fund manager, it's not like they stick to that 1 or 2 or 3 funds or fund managers. I think that a lot of people love to have novelty. And what do I buy this time? What looks good? What looks interesting? Advertising and so many things. And, you read different things. So a lot of people do get carried away by the amount of choices. And we all know there are books and books and books written on this. Like Barry Schwartz has written about the paradox of choice.
Yes.
And I think given too many choices, people make suboptimal decisions.
Yes.
So the fact is that if you have 8 or 10 different mutual fund schemes, equity mutual fund schemes, just imagine each of them having 40, 50 stocks.
Yeah.
You'll end up with 350 to 400 stocks.
Yeah.
And you go around deduplicating it, you will still have 200 plus unique stocks. Now, a good way to figure out what happens when you have 200 unique stocks is that you end up owning about 85% of the market.
Exactly.
Because BSE 200 stands for 85% of the market cap. So if you have 8 or 10 equity mutual fund schemes, it's a very, very expensive way of eventually mimicking BSE 200 or something like that.
Exactly.
So then you might as well, look, if you are going to buy actively managed equity funds, then just like you want the fund manager to stick his neck out and make certain choices to beat the index, then you as a fund picker also will need to stick your neck out and make certain choices. But if you don't stick your neck out, you have 10 different funds, that's not a choice, that is spray and pray.
Yes.
And then you eventually end up owning the market, so might as well end up with the market.
Okay, so fair point. Now, I want to bring in just a counter argument here, and something that I was trying to allude to earlier. I'll make it slightly a little clearer now. The reason why I think people speak about passive in a bull market is that they've perhaps forgotten about the kind of beating that an index as a whole took during a bear market. So generally, the objective of an active fund manager is to beat the benchmark, either on the downside or on the upside. On the downside, the fund manager is protecting your capital. That's not something that you would see in an index fund, right? So that's something to be aware of.
Yes, absolutely. I mean, you're basically tracking the index. So I think there are solutions out there that can help you protect downside, but I think just at the fund level, I think I think you're basically getting what the index is giving you. So if the index is down 40% tomorrow, your funds will be down the same amount.
Yeah.
So I think that, and I think the reason why that protection is also important is because when some people are doing your monthly investments month over month, year on over year, those actually downsides are actually good because those are the months where you can actually build your portfolio towards getting those really good long-term returns.
Opportunities to buy, sure.
Absolutely.
Okay. I wouldn't say, Aashish, that buying passive either, and we'll get into the details of index versus ETF as things stand now, but I wouldn't say that buying passive is a one-size-fits-all solution, right? So how do you go about allocation? And after that, we'll come to which you should buy in terms of index versus ETF.
Look, even in the whole mutual fund spectrum, what I've seen is that there are, within active mutual funds also, there are funds which actually run their portfolios with certain underweight and overweight positions
Yes.
Vis-a-vis the benchmark
Yes.
index.
Yeah.
So, because what they are doing, these kind of funds, what they are doing is they are hugging the index, thinking that, if we deviate too much from the index, then yes, it might give us outperformance. But if it goes the other way, then it might give us significant underperformance
Yes.
also. So what I've seen is that, broadly speaking, there are the index funds or the ETFs which track the index, and then there's a huge segment of funds which are actually index plus, meaning in some way or the other they are tracking the index, but they are just running underweight and overweight positions, which are basically their sector calls or stock calls.
Correct.
And then there are guys like, for example, Motial Oswal on the active side is one of them, where we run seriously active positions. I mean, we are running portfolios which are benchmark agnostic.
Okay.
Right. Meaning that, for example, theoretically, if I'm negative on IT and IT is 12% on the index, nothing prevents me from being zero.
Okay.
Right. So that's like a seriously active call.
Okay.
So what I've seen is that when investors are allocating their monies, I think that they need to understand what kind of styles. Pratik already clarified. Our genuine belief is that you need active as well as passive both in your allocations. But then the passive should be used for certain core allocations, and the active should be used in order to generate a kind of a kicker or a bit of, to give you certain thematic exposures or to get you into certain sectors or ideas which are slightly ahead of the curve. Take an example. The first insurance company and asset management company in India got listed a year and a half back. Now, no index has these kind of themes or these kind of stocks. So the point is that there is a role for both. You just need to be conscious what role it's playing in your allocation.
Okay. So obviously it has to, you wanted to make a point, Pratik.
Yeah. So just wanted to say that, I think a lot of the conversation today, I would say 90% of a lot of conversation in, especially the media or newspapers, is about fund selection.
Yes.
It's about which fund to buy, which fund to sell, etc. But when it comes to creating wealth, that is just 10% of the process. It's about discipline. It's about, waiting. It's all about sticking to your guns. And it's a very long and boring process.
It is.
And the moment it becomes exciting, you're doing something wrong. So, I think, and I think studies have also already shown that, it's not the fund selection that gives you returns. It's about the combination of those funds over time, like your asset allocation.
Yeah.
So, for example, someone who's a bit riskier or who's younger can probably do a higher mid-cap allocation.
Yes.
And someone who's more risk-averse can probably do maybe larger debt or more of a large-cap exposure. So, I think that is something that, what advisors mostly are, or financial planners. So I think those sort of conversations are getting increasingly important. And we're looking at pure asset allocation. That's why passives, I think are more appealing to investors because they're much simpler. Today a small cap fund might have a 35% allocation to a large cap index.
Yes. Yeah, that happens often. Yes.
They might have an HDFC bank or something like that. But whereas a small cap index fund or an ETF might be pure. So I think when you're looking at creating an asset or multiple asset classes, passives offer you that purity, which I think is...
Let's drill down a little bit, and this is really coming into the operational part of this conversation, and I leave it up to you to who will take this. If somebody is sitting down and saying, okay, I need to make a significant allocation towards an index fund or an ETF, which should they choose?
No, I think every investor, the younger the investor, the better it is for him or her to reap the benefits of passive investing, is to at least allocate. Today, I tell people to allocate at least between 15 and 20% of their portfolio to passives, which is something like a core portfolio, which you won't touch till you retire. Because that's when the benefits of passive are, across many years. So just to give an example in the US, so the S&P 500, which was the first ever index fund launched in the world, launched in 1976.
Yes.
It survived 45 years. It's today the most popular and the biggest fund in the world, $800 billion. And in that same time period, you have around 2/3 of all other funds in the active space that have shut down or merged. And out of those, maybe 3 or 4 have outperformed the index. So I think when you're looking at investing for long time periods, also when you're looking for investing during periods when you're I think very volatile. You want some part of your portfolio which is number one low in terms of volatility, Number two, I think consistent in terms of risk, and something that is more long term.
Fair enough. Aashish, we briefly spoke about this before we got recording on this podcast, between ETFs and index funds. And I think Pratik broached this just a while back, saying that he's tending towards advising for index funds rather than ETFs. There is a bit of a discrepancy, or rather there's a bit of a fallacy in terms of the cost and the perception of cost, right? People think that ETFs are significantly less costly,
cheaper,
but that may be a bit of a fallacy.
No, so look, one of the prime criteria for deciding between an ETF and an index fund, clearly one is what Pratik mentioned, that if you're like a really long-term investor, you want to buy and you want to forget it. See, ETFs are, so for long-term index is the best.
Yes.
Now, ETF is for someone, who's running, let us say, who wants intraday trading, who wants live prices. There are people who might buy some index and short some futures.
Correct.
And, they're running a variety of strategies, etc. So that is one choice, one reason for choosing ETFs, which is that you want active, you want live trade like a stock. The second clearly is that, yes, because ETFs are listed, and there's no processing of transactions and all those kinds of things, the cost tends to be cheaper. But you know what? There is a concept of total cost of ownership, which one needs to keep in mind. It's not, because the cost of owning a fund is not just the total expense ratio of the fund. There are 4 or 5 things in this. One is clearly that when you buy, is there a entry cost or a transaction cost? So when you buy an ETF on the exchange, of course, there's a brokerage you're going to pay, and then there is STT. When you sell, there is a brokerage and there is STT. Then there is the cost of the total expense ratio of the fund. And very importantly, most of these ETFs are not very, very highly traded in the markets, right? Yes. So there's this concept of a market maker whose job in life is to absorb supply when somebody is selling and give out supply when somebody is buying. And of course, they don't do it for free.
Yeah.
So look at it this way, like we run our index funds and the cost is 35 basis points for the direct plan of the index fund. Now someone can say, okay, I found an ETF which is only 15 basis points.
Yes.
So it's much cheaper.
Yes.
But the point is that if you pay 15 basis points for owning the ETF, but while buying and selling, if you have to pay 0.5%, the bid-ask spread is totally 1% on half and half on both sides. So, let us say the NAV of the ETF is 100. If you want to sell, the guy offers you 99.5. And if you want to buy, he sells you at 100.5.
Yeah.
So the cost is 15 basis points TER, but there is a 1% you lost from the NAV. Whereas in an index fund, if the NAV was 100, you would have got it for 99.65 on an annualized basis, right? So I think total cost of ownership is more important. And my understanding in the current Indian context, index funds have a total cost of ownership which is lower than ETFs for all of the retail investors. I can say that for sure. And if you're really a long-term investor who doesn't care for live prices and all those kind of things, then you're better off just holding an index.
A fair point there. Just a small point though. Obviously, it might just be a conversation for another day, Aashish. But when you have that kind of liquidity for ETFs, and when you see that spread reducing, that's perhaps when you can look to enter.
Yeah, if I have to hazard a guess, I would say that the spread for Nifty 50. Maybe Nifty Next 50, I can make a guess that they'll get finer and finer and finer and finer over a period of time. But the fact that all ETFs have a market maker, look, when you call somebody a market maker means there's no market. There's somebody who's making the market, and hence he's the one who's giving and taking supply. And clearly he's not going to do it in a costless fashion. So if there is a market maker who needs to make money and yet give you a very fine pricing, then he needs like a humongous amount of volume, because then instead of 1%, he's okay to make 5 basis points, but he wants 5 basis points on a huge volume. Now, if you're not going to have that volume, then the spread will be higher because nobody's doing charity. So I think this is going to take time, at least as far as the Indian market is concerned.
Okay, closing comments from the both of you. And if you're talking about the average retail investor, and obviously on BloombergQuint we have several very in-depth conversations with individuals, because we believe that everybody's context is different. And I want to put that disclaimer out. But from the perspective of approaching passive investments, you said 20% of your portfolio broadly is something that you can consider doing for the long term. But even within that, would you say that you can approach it in a slightly nuanced manner? You can look at a split between the large caps, because a lot of people I speak to on index funds talk about the Sensex and the Nifty. They're the most visible. But that's not necessarily the only option available. In fact, it clearly is not.
Yeah, right. So the way I look at it would be twofold. One is the risk profile of the person investing.
Yes.
So I think someone who's relatively younger, who could take a longer call, who can take more risk, should definitely do sort of a little bit more allocation to mid cap than a large cap. But I think in an Indian context, I think what you have to understand that, I think Indian markets are not as efficient as markets in the West. So I think I think ideally the reason why index funds or ETFs have taken off is because a lot of people today assume that large cap funds will not outperform the index. So because those stocks have become very efficient. So I would say for an investor who's looking to sort of invest in their large cap mutual fund can also look at allocating some of their portfolio into a large cap index fund or an ETF.
Yeah. All right. So that's I think that broadly covers the concept that we had to cover today and passive funds. If you have any questions, dear listener, do write to us on any one of our social media platforms, and I'm sure my friends here will be more than happy to help you out.
Yeah, sure.
I'd like to thank both of you for joining me on this conversation. Thank you so much, Pratik and Aashish, for helping our viewers out.
Thanks for having us.
Thanks for having me.
All right, so that's all we have on this podcast, but there's a lot more that we've discussed already on BQ Big Decisions. If you'd like to listen to any of those conversations, you'll find them on any one of our podcast channels or in fact on the website BloombergQuint.com. If you're looking for other coverage on personal finance, you'll find that on the website as well. Thanks so much for listening. This is Alex Matthews signing off. Have a great weekend.
If you enjoyed Big Decisions, check out some other podcasts on the IVM Podcast Network. You can check out Paisa Vaisa, hosted by Anupam Gupta, Advertising is Dead, hosted by Varun Dugirala, the Ronnie Screwwala podcast, hosted by Ronnie Screwwala, or Cyrus Says, hosted by Cyrus Procha. These shows are available on the IVM Podcast website, app, or wherever you get your podcasts from.
How aware do you think you are of your laws and rights? Do you look up to laws when you are caught up in situations? Do you know what your rights are when you're stuck somewhere bad? Well, here's a show that can help you move an inch closer to being aware of what your rights are. Tune into Know Your Qanoon with me, Amber Rana. This is a podcast meant to answer all your law-related queries. Catch Know Your Qanoon every week on the IVM website or the app or anywhere you get your podcast from.
I hope you enjoyed that show. We'd like to thank our sponsors this week, Intel, Storytel, and Cambly. And let me tell you a couple of things that you should check out this week. On Mr. and Mrs. Binge Watch, Janice and Aryu talk about Season 3 of Netflix historical drama The Crown. And they list the TV shows and original movies they're looking forward to in the month of December. On Geek Fruit, Tejas is joined by fellow geek Vikas Munipale, and they talk about the ever-expanding world of video games. On Know Your Qanoon, Amber talks about the Transgender Persons Bill of 2019 and highlights the problems that one must look at in the bill. On Edges and Sledges, Ashwin, Varun, and DJ talk about all that went down in the pink ball test, speculate about MS Dhoni's retirement, and look ahead to India's T20s versus West Indies. On Golgappa, Trupti is joined by Aarti Vadakbalkar. She talks about experimenting with one's comfort zone as an actor and her brand Color Chop. On Paperback, Rachita and Satyajit are joined by writer Dishant Huria, who discusses his first published novel called When Karma Goes Upside Down. Thanks and keep listening.